Hello, everybody. So great for you to be able to join us on this Wednesday evening. Today is St. George's Day, so happy to everybody celebrating St. George's Day. My name's Ashley. I'm going to be running you through today's webinar, which is Real Estate 101. It's going to be part of our Real Estate 101 series. I hope that you guys will get a lot of value from today. If you do have any questions as I'm going along, please feel free to put them in the chat, and one of the team will pick them up later on if I'm not able to answer it during this meeting. We've got a great agenda. We're going to do a quick intro to real estate. Obviously, my main aim today is to provide as much value as possible, and that you guys will come away and take away some useful advice and information that we're going to give you today. We're going to go through Pacesetter's investment framework. So we're going to give away a bit of the secrets of how we look at real estate investing. We're going to quickly touch on some strategies and the strategy that we prefer. I'm going to go through a real deal with you and how we understand these deals. And it's a really, really good deal. So definitely stick around for that. And then with some time at the end, we're going to touch a little bit on stock investing, because although I'm mostly a real estate investor today, my first true love of investing was in stocks. So we're going to cover a little bit about that today to set up for future webinars. So let's start with our intro to real estate. I'm not going to spend too much time on this because I'm sure you guys already know that real estate basically is buildings. And this usually comes into three categories. So we have residential, so you have things like apartments, basically places where people live, commercial, which can kind of be summed up as, places where people work, but also shops, where people buy things, real estate where people buy things. And then finally industrial, so things like factories, warehouses. All of these are good investments or can be good investments. But we mostly stick to residential, and that's what we'll be talking about later today. So let's talk about returns. How do we get returns from real estate? The most probably common way people think you get returns from real estate is in terms of income. So obviously you have your rental coming in every single month, and that is a big way of how you make money in real estate. But also there's something called capital gains, and this is essentially the value of the real estate going up, but also it can go down, as happened in 08, 09. It's not just a one-way trajectory. So we're going to talk about capital gains in the next couple of slides and how we can make the most of that. And then later on, we'll come into income. So when we're thinking about capital gains and capital appreciation, there's two ways that this can happen. Through forced capital appreciation. So this is when we do something to essentially make the value of the property go up. And unforced capital appreciation is when it kind of goes up naturally because of market forces, because of things like inflation. The prices of everything tend to go up over time. And of course, real estate and property is no exception. Of course, there are exceptions to this when this can happen during panics, when people want to sell a lot, but generally, historically, over the long term, real estate tends to go in one direction. Okay, so let's talk about unforced capital appreciation. Now, the reason I've got a picture of some grandparents in front of a very nice big house is because I think we all know that the generation of our grandparents and before that, and to our parents to some extent, speaking from the point of view of someone in their 20s, they did pretty well from real estate in a lot of countries, especially the US, especially Western countries like the UK as well. They bought a property, in 1950s, 60s, 70s, 80s, even into probably the first half of the 90s, and that it's just gone gangbusters since, to the stage where you have people on modest incomes, modest salaries, but because they own their own home, they're very, very wealthy today. So these grandparents, they might have bought this house in 1959 for $100 and 2 bottles of Dr. Pepper, and today they're real estate millionaires just because they bought early and they held on to it. So this is essentially what we mean by unforced capital appreciation. Just over time, property tends to go up, which is why it's one of the reasons why it's a good investment. So let's talk about forced capital appreciation now. So there's two ways that we can do this. There's many ways, but there's two main ways. So number one, you can renovate the real estate. You can take out old kitchens, old bathrooms, which can also really add a lot of value to the property if they're brand new. So you can force the appreciation through renovation, just general upgrading, because obviously if these grandparents still had the same house and the same living room exactly how they did in the 50s, today that might not be so attractive. So obviously over time you will update it and force the capital appreciation a bit that way. Another way you can do this is through adding a bedroom or using a room as a bedroom. So for example, let's say this is a very basic flat. It obviously has an upstairs or downstairs, but let's say back in the day this might have been used as a living room, this bedroom 3 here. Instead of it being used as a living room, you would use that as a bedroom, and you would put the living room maybe in a smaller place. Like you can see here, they've got a small lounge, which should just be like a little TV room or something. And so, you could use that as a bedroom. And so if you're renting out, instead of this being a 1-bedroom apartment, this is now a 2-bedroom apartment, and you'll get some generally more rental income if based on the same standards if you have a 2-room apartment as opposed to a 1-room apartment. Okay, so let's dive into our frameworks. How does Pacesetter think about the business of investing? Other businesses, they might, approach sales in a certain way. So they have to have some sales frameworks. They might be, in the business of marketing that heavily. So how do they think about marketing? How do they think about making iPhones? Our business is investing. It's real estate, but we need to have a kind of framework how we approach investing. And so we come across this with 3 main points. So I'll be going through these with you and explaining them in quite a bit of detail so that you understand. Okay, so the first framework that we think about is that we love to say no. Now, some of you on the call I know have done sales before, so you're not a stranger to no's. And why you love no's in sales is because they bring you close to the yes. And it's kind of a similar framework when we're thinking about real estate, because every deal that we say no to, every property that we say no to gets us closer to the yes. And the reason we'll say no in 99% of cases, and by no, I mean, we won't proceed to even investigating that property, is because it doesn't fit our criteria. And when you're investing in anything, whether it be stocks, whether it be real estate, whether it be art, anything, you need to have a very strict criteria of what you're willing to say yes to. And we'll go into this a little bit later in terms of thinking about hurdle rate, what's our minimum return, et cetera, et cetera. Now, the image on the screen is from a book called The Science of Hitting by Ted Williams. He was a baseball star in the previous century. And for those of you that are listening from America, you'll know that this is a strike zone. And he essentially said that if I will only hit balls that are directly within my sweet spot, in this case, it's the red 3 sections that you see here, then he'll have a very high batting average. He'll do very well. And if he misses, and if he doesn't swing at the parts of the strike zone that are not in his circle of competence, his ideal shot, then he won't do so well. And so that's a very similar framework to think about when we're investing. If we try and take investments, swing metaphorically at investments that don't really fit our criteria, but we're going to swing anyway, then we're going to have bad results. So we need to be really strict as investors in real estate or stocks, or whatever it is, to only go ahead and purchase and investigate investments that are only going to be within our ideal zone. So the narrower that is, the more no's you're going to have, the more properties, the more investments you're going to need to reject, but the better results you're going to have on the few that you are accepting. So we have a very, very strict criteria when it comes to investing in real estate. And I would recommend yourselves, whatever your field of investment is, to be very strict on what you say yes to. So just an example of that is on the next slide. So I've taken a random city in the UK. We've taken Manchester. Within this screen, there are 5,000 properties. And that probably means 5,000 properties for sale. You can see down here, there's too many properties. So there's over 5,000 because 5,000 are hidden. So count up everything that's on the screen, add another 5,216 to it. And that's the amount of properties that are for sale at the minute. So that's a lot to say no to, a lot to say no to. So you really have to have a framework of like, okay, where am I going to look? What's my target area? Because if I have to investigate all of these properties, it's going to take me ages. So I might pick a certain area and I'll just zoom in on that area, and that's what I'll focus on. And you might pick the area because it has good schools. You might pick the area because there's universities there. You might pick the area because it's the city center. So there's plenty of areas that you could say, okay, I'm going to investigate here, but you really need to be very specific. And that's just the start of the journey. From then on, you need to write, okay, what's the rental here? What's the price? So really the start of the journey is figuring out where's your sweet spot going to be. Charlie Munger used the example of a famous real estate investor whose name escapes me, who only invested in real estate that was within, I think, 3 square miles of the Stanford campus in California, because he knew that that would always be a really good place to invest because of the university, because of Silicon Valley. So yeah, finding your niche is really important. So because then it's going to build on you're going to build your framework on from that. So our second framework is kind of similar, is we never compromise on our hurdle rate. So let's say we found a property, it ticks all the boxes so far, but then we do some investigation on what's the return, what's the percentage, what's the cost, okay? And if it doesn't meet our minimum hurdle rate, which is our minimum rate of return, then we just say no. We just say no. I might find the most amazing apartment, it just looks good, the price is right, but then I do a bit more investigating and I figure out, okay, we're not going to get the rental that we want here, or you know, I've done some analysis and it's just too far away, a little bit from our ideal area, so we just can't justify it, or it might cost this, but based on the valuation, the electrics are bad, so actually we're going to be spending too much money on it. Whatever the reason might be, if it doesn't meet this hurdle rate, then we just don't go ahead. And I've got an example of that on the next slide. So in Scotland, this is a real deal that I found about a month and a half ago. And we have a minimum hurdle rate of 23%. So that means we want our annual returns after tax to be at least 23%. Now, this doesn't include things like unexpected maintenance. This doesn't include void periods, because we want to have a margin of safety there. But most people, when they see this deal, would say, you know what, I know the hurdle rate's 23%. I know that I'm supposed to stick to that hurdle rate, but 22 and 15% is still good. We'll just go ahead anyway. And we are so strict with that. We are so strict with that because, you know, we're managing, you know, we have investors, we have shareholders. You know, if I start to compromise on these tiny little percentages, you know, you never know. You never know what could happen. So we really do stick to our hurdle rate. So this is, yeah, really important. So your hurdle rate might be different. It really depends on your area. It really depends on where you're investing. It depends on your own personal preference. You might be happy with 10%. You might be happy with 15, 5. It's totally up to you. You are kind of bound by what's in your market. So if you're in Warsaw, you know, you might have to accept a hurdle rate of 14%. Like there's some deals that are good and that you can get for 14%, but you're never going to find deals, for example, for 20. It depends on your market. And as you're doing your analysis, you'll kind of figure that out. So yeah, we're really strict on our hurdle rate, and you can do this for stocks as well. Like if your expected returns are 15, but then you do some analysis and you think, actually moving forward, I don't think this stock is going to return me more than 10 a year, then, you know, you just pass. The other reason why baseball is a good analogy is you can think of investments like baseballs. In baseball, if you don't try to hit the ball, eventually you'll be out. In investing, there's no such thing. You can have investments fly by you time and time again. You do not have to swing. No one's going to shout to you, swing, what are you doing? You can just let every single property, every single stock go by you, and there would be no called strikes. No problem with that at all. Okay, so our third and final framework, when we're thinking about the business of investing, is how we buy is as important as what we buy. So what we mean by that is you could have the best property in the world, but if you overpay, then you're not going to get a good return from that. Howard Marks has a famous saying who's a famous investor, recommend to look him up. He has great material. there's no such thing as bad assets, there's only bad prices. So he's essentially saying that any asset is good as long as the price is right. And this goes for a lot of things. You could have a property that's in the worst condition. And I saw a property recently that was basically infested with pigeons. It was head to toe in pigeons, but it was selling for only £12,000. So, you know, if you figured out that problem and you renovated it, you might be able to sell it. You might be able to spend 30K on it and sell it on for 50. You know, it could still be a reasonably good investment. So this is the way we think about it. So we want, you know, we want good assets, but we really do want to focus on our price, because mostly in investing, price is going to determine your outcome. Your profit is going to be built into your price. If you overpay, you need to really push to get that profit at the end. But if you get great value, then you're going to be pretty much on to a winner. So how we think about this is in the form of a question. So is our price so good that we could essentially sell at a profit straight away or nearly straight away? And we think of this in terms of market value or commercial value or both. So I'll explain what those mean on the next slide. But essentially, we want to pay such a good price that we could basically sell straight away or near enough straight away and make a profit on it. That's what we're kind of looking for at market value or commercial value. So let's explain what those are. So market value is essentially the value of the property as it is, based on the bricks, the mortar, the location. And this is generally what people will pay when they're buying a house to live in, roughly, because, you know, they're not thinking of investment value, they're just thinking of it to live in. Now, you may get someone that completely overpays because they just fall in love with the house. But generally, this is pretty stable, this market value. However, investment value is based on looking at the property as an investment. So rather than a home, this is kind of like a simplistic way to think about it. Market value is if someone was going to live in it, and investment value is if someone is using it as an investment. So you might have a house that's worth 100K market value, but let's say you could rent it out for 15K per year. Is it still going to be worth 100K? No, it's probably going to be worth more, because someone might be happy with a decent return on it. So they might be willing to pay 110, 115, 120. So investment value is generally an increased from market value because it's seeing the property as an investment based on its cash flows and things like that. So from our side, we might want to pay 90,000 for a property that's market value is 100. In a perfect world, that's what we'll do, because we're buying for 90. We could sell it on, minus obviously tax and costs, for 100. So we have some decent profit there. Wouldn't be quite 10K because of taxes and costs, but there's some good profit there. Or we could sell it on for 110. Let's say in our example, we think we're able to rent it out for 15K per year. We'd get more than 100 for that. So we could sell it on, we'd get a tenant in, we'd keep the tenant in there for some time to show that, yes, this tenant is paying and this is the actual cash flow you can expect per year. And then we could sell that on. So there's some really good profit there, and we'll use a real life example in the following slides. Okay, so let's talk about strategies. Renting, building, flipping. These are kind of three subheadings. So renting is falls into two categories. So it can be long term. So you rent to families, you rent to students, for at least a year, things like that. General long term renting. You can also have short term renting. Most famous beneficiary of short term renting is obviously Airbnb. So buying a property and renting it out for tourists, people that are visiting and they don't want to use hotels. Maybe they want to save money, or maybe they want to cook for themselves, whatever reason. So that's Airbnb. Building. So actually building something from the ground up. So very, very commonly you would do that to, some people want to live in it, but very commonly in terms of investing, you would do that to sell. So you build your house for £200,000 and you sell it on for £250,000 and you make some profit. It's becoming increasingly common though for people, especially in apartments, people that are building big apartment buildings, to rent those out because they like the cash flow, they like the regular payments. So that is becoming increasingly common. or you can refinance it. So you can, instead of selling it on, you can refinance it and keep the building, but release some equity. And we'll touch on refinancing pretty much in the next webinar, because it's a bit more advanced to think about. And then flipping, as we mentioned, so just flipping the apartment, buying it. Maybe it's in a bad condition, maybe hasn't been updated since the 50s, and we're improving it and we're selling it on. So we're raising the value using our one of our forced capital appreciation methods that we used earlier on. Now, pacesetter strategy, coming back to us, is student rentals. Why do we like student rentals? There's predictable leaving dates. So there's nothing worse when you have someone that isn't paying and there's no real end date. You don't really know when they're going to leave. With students, that's not really the case. You kind of know when they're going to leave, usually the academic year or semester or whatever. We like student rentals because obviously we operate in the UK. There's high demand for that. Students very often do want to come and study in the UK. So we foresee in the future that being the same. Rent, depending on the age of the student, obviously, but rent is often covered by parents because students might not have had their income yet. And so it's not really the tenant paying the rent, it's often the parents. So the parents send money, students send it on to us, and it's just simple as that. So there's less of and also that's good because there's no, if a regular tenant loses their job, that could be an issue, but with students, that's less likely to be the case. They're less fussy about conditions, so they're not gonna mind too much about, having a brand new kitchen and, brand amazing living spaces. The standards are a little bit lower. On the flip side of that, a disadvantage is they might take less care of the place. We personally haven't had that, but that is a potential downside for that. But it means you have to spend less on getting the property to a very good condition. Instead of having like brand new everything, you just kind of provide good furniture and this and that. The other thing is we rent by the room, so there's the potential there for higher income. So instead of renting one apartment, you can rent 2 rooms and you get more income from that. And so that's why we like student rentals. Okay, so let's go into understanding deals now. So this is how we essentially look at deals. So I'll start by looking at Glasgow, which is the city we operate in at the minute. We will probably expand in the future. And then I'll narrow down based on location. So, looking at this screen, I can instantly see that at least half of these properties are going to be passed because of their location. We'll then assess price and obviously go on the listing. By the way, this is a real deal that we're going through the legal process at the minute. We should get the keys for this sometime in June or July. So we're going through the legal process for this. And so the price is right, 73,000. We like it because there's 2 rooms. We can rent this out, no problem, to students, and they'll like that. So instead of a 1-room apartment, this becomes a 2-room apartment. It's in a decent condition. Some work does need to be done. Like obviously we'll change this bed. We'll change this into a bedroom. So we'll add a bed in there, but kitchen is pretty good and everything else. So yeah, we'll check the price is right. We'll check the condition. Okay, so on the face of it, things seem all right. I'll then determine the rental value. So in our instance, we've determined the rental value to be 625 for the biggest rooms, 575 for the slightly smaller room. So 14,400 annually, based on 12 months, of course. This is assuming no void periods. So 25% deposit, lawyer fees, taxes, how much are we going to spend on furniture, and with a margin of safety for the furniture, just in case something comes up in terms of electrics or something like that. So we think we're going to spend around 30K. This is the rent. This is what our mortgages are going to be. And then our pre-tax profit is this. So our total returns are 30. You're going to need to take away 20% of that 30 to come up with the obviously after tax return. So this is going to end up in 24. So this meets our criteria. So this is a real deal. And just to give you an example, so you'll get an appraisal before you can work out the furnishing. Obviously, you'll go on the appraisal, the valuer's report, see if there's anything in there that looks like you might need some extra work. If there's something horrendous on there, like there's a leak in the ceiling or something, we'll probably give it a pass. And then I'll go ahead and view. I'll reevaluate after the viewing. Maybe there was something that I didn't pick up or that isn't picked up in the report. Like maybe the windows weren't noted on, but you see that you're actually going to need to replace one. And then we'll reevaluate based on that. And then we'll do the ROI again. If it meets our hurdle rate, then we'll go ahead and we'll proceed. Now, this deal gets even better because of what we spoke about earlier about market value and investment value. So this apartment's market value, and this is done by an appraiser, not by me, they said the value of this apartment was 85,000. So in theory, minus costs and taxes, we could sell this straight away after maybe some waiting of finding a buyer for 12,000 profit. So we'll get 42k back from our initial 30, which is an increase of 39%. So that's really, really good. It gets even better when we look at it from an investment value because, for 14,009 after costs, if someone's looking for, a 10% return, obviously we'd have to wait some time to demonstrate that this is actually what the apartment is producing. But there's no reason why we couldn't sell this for 95,000 based on its investment value. And so that would increase our profit to 22k plus minus obviously costs and taxes. So this would mean that 52,000 back from our 30,000 outlay is a 72.63% return, which is amazing. And obviously in the meantime, we could be getting rental income. So yeah, you can kind of see now why we're really strict with our deals, because when you do find like an amazing deal like this, you need to take advantage of it. And if we had spent this 30k on a deal that wasn't so good, we would be missing out on great deals like this. So this is what we're kind of looking at when we're looking for deals. So for the final few minutes, I'll just give you a quick intro to how we think about stocks. Now, obviously, us as a business, we don't invest in stocks. I do personally, but I know that a lot of people on the call, they want to learn about that side of investing as well. So I'll just spend a minute or two just to speak about that. So I personally am a value investor. So when I'm looking at a stock, I try to get more value in return than what I've paid for. Now, don't worry about what these all mean too much. We'll cover that maybe in future webinars. But essentially, the market capitalization is how much you would need to pay to get control of that business, to buy the whole business. So it's the share price times the amount of shares. So in theory, you could buy this business for just less than 9.5 million pounds. However, the business has cash of 15 million pounds. So what you need to imagine is, obviously we wouldn't be buying the whole business, but as a stock investor, you need to think, if I was buying the whole business, is it good value? And if I don't know about you, but if I could buy a business for 9.5 million pounds and I would get 15 million pounds cash back, that's a pretty good. Now, obviously you'd need to check profitability. Is it making money? In this case, it is making money. So so in future webinars, we'll go into more detail about how I find, really good investments that are selling for less than they're worth, why that's been a good strategy historically. And we'll talk more about that. So we'll cover real estate mostly, but maybe talk about stocks later in the year. So thank you for coming. You can follow us on our Instagram, Pacesetter Capital. It's a bit quiet on there at the minute, but we're definitely going to be using that more and more as time goes by, uploading videos, things like that. So please give us a follow. The next webinar is already live, so you can go on LinkedIn right now and click attending to this webinar. It's going to be on Wednesday, May 21st, same time. And in this webinar, I'm going to be covering scaling up. So we'll cover a little bit on getting your first deal, and then we'll talk about how people go from, one property to 5 properties in the course of, a very quick period of time. And I'll also cover market cycles. So how we should think about protecting our downside, thinking about risk, et cetera, et cetera. So that's going to be in 4 weeks' time on the 21st of May. So I really hope to see you there. If there's been any questions, comments, anything like that, the guys will answer it after the meeting. But thank you very much for coming, and I really hope to see you in 4 weeks' time. Thank you so much.